Hi everyone, welcome to Forex Signals TV. My name is Connor Woods, market analyst at Forex Signals and howtotrade.com. It is that time of the year when investors scoot off on their holidays for a well-deserved break over the Christmas period. And during this period, it's a great time to plan the fantastic opportunities 2023 is going to throw our way. The best way to start is to analyse the 2023 outlooks from the big banks, which are now available to dive into. Now, these are often overlooked due to the complicated language and the sheer number of pages, and that is why today I will condense two of the top 2023 bank forecasts into the information that is important to us as traders. From there, I will provide my two top plays as 2023 begins, because after all, these banks are the real market movers, so why would we not want to listen to their thoughts? Let's take a look at the forecast now.
Okay, so firstly, let's take a look at what Barclays think about the markets and the global economy in 2023. Now, they released this back in November, and you can access it on their website, but we'll drop the links in the description for both of these coming up. Now, Barclays are a British multinational universal bank with total assets of over £1.3 trillion. So it's important that we read this with great care, of course. Now, I'm going to go through and summarize it for you nice and clearly. Now, for me, the first page really set the mood of what we're going to read in this report. And the sort of language that they use in this report included things like rebalancing, difficult, and uncomfortably constructive. Now, they point out that we need to tread carefully as Europe and the UK are likely to be in a recession, and that the US is showing more signs of encouragement. But the thing that I took most from this first couple of pages was this quote here about be aware of being too pessimistic. Now, the quote says next year will be a difficult but necessary rebalancing act for central banks, governments, markets, and investors alike. But amid all the pessimism and concerns, we see more opportunities today than at any point in the last few years, which suggests to me that the mood of this report is one of recession, but also one of picking individual stocks if you are a stocks trader. Now, this was probably one of my favorite pages of the lot. They talk about, the global economy and they summarize it here. And what you can see is in 2023, they believe the global economy is going to grow by 1.7% in terms of real GDP, which is the primary measure of economic growth in an economy. Now, it's clear that from this page, we can see that Barclays think that the global economy can keep its head above water, which is a quote they've got here. But the main strength to the global economy will be thanks to emerging markets, particularly India, whom they feel will boast a 5.1% GDP growth in 2023, which I found quite interesting. The report sort of then dives into, the important areas, and to summarize those areas for you, they believe that, for example, the US economy is going to have rays of hope, but they do predict the S&P 500 to be at 3675 come the end of the year, which is going to be important for our trade ideas in the later part of this video. They think Q1 is going to be particularly rough in general across the globe, and then smoothen out as the year progresses. They mention as well in the report whether China can get its mojo back, and highlight sort of the reopening of the economy to be the real key to all of this. Now, when you scroll through and see what they talk about in terms of the Eurozone, you don't really need to look too far in terms of what they say in terms of the titles. They say the Eurozone feels the heat. They feel that the Eurozone and the UK are likely to feel, the real wrath of a storm, according to Barclays, and they predict -1% GDP for the UK. If I go to the UK one here, you can see that -1%, which is quite significantly lower than anywhere else. They think minus 0.8% for the Eurozone. So those two are the main worries. Now, overall, they do predict global equities to fall at an average of 10%, which I found interesting. Because when we look on the chart, we can see we can actually measure that 10% and potentially use that as targets. But I do feel it will be slightly worse in the Eurozone and the UK. Now, when we look at the key takeaways for me is they said on there to be comfortable with being uncomfortable, which is a weird thing to say. They're probably one of the biggest bears through this report. They're one of the biggest bears out of all the banks and the major players who released their forecasts. They made it clear they think the UK and Europe are going to suffer more. They made it clear that there's going to be a volatile year ahead with sharp corrections. which is what we've seen going in towards the end of 2022 as well, those sharp corrections, those bear market rallies. They believe there's going to be a 10% fall in equities on average from here, and that's from the beginning of November, or around the second week of November, so we'll mark that. And again, they believe that the first half of 2023 is to be the worst. So that's Barclays' general view and how we can get those key takeaways and then marry them up with the charts. Secondly, let's have a look at JP Morgan. Now, JP Morgan are an American multinational investment bank and financial services holding company, and they're headquartered in New York City. Then this is considered, to be honest, one of, if not the leader in investment banking, equity of over $290 billion in 2021. So huge, huge impact on the markets. Now, I must say I do prefer the angle that JP Morgan take to Barclays and the approach that they've taken towards that 2023 forecast. Theirs is much shorter in length and it's summarized brilliantly on page 16, which is where we're going to have the most of our analysis. Now, it outlines what would need to happen for each scenario in equities and also in fixed income and Forex as well. Now, its core view really, though, is that the markets will fall into a mild recession in 2023 off of the back of tighter financial conditions. So if I scroll through it now, you can see they go through it in individual detail, which is great. If you go to the bottom, they've got this fantastic summary page, which I want to show to you now. So really, if we look at because I've read the report and where they think really we're going to be, is I'm looking at this bottom left quadrant to be the main player from what JP Morgan say this year. Now you can see in there talking about fixed income, they think stagflationary pressures could limit government bonds' ability to diversify equity losses, which is interesting. And they think that credit spreads widen with riskier sectors hit the hardest. More importantly for us as real traders, of equities, of currencies and commodities, etc. For equities, they believe that on this quadrant here, which is the downside of the markets, they think the worst scenario for equity markets with earnings hit hard in this particular quadrant, and they think that the quality and defences particularly outperform in this case, and that in currencies, although that people are sort of turning towards this dollar weakness in general, they do think there could be some safe haven flows to boost the US dollar. This will be the case if there is persistent inflation and a deep recession. Now, if there's moderating inflation and mild recession, those effects are tailored back a little bit, and potentially, because if you look at what the picture they used here was a bad year for the economy, a better year for markets, with the sun sort of coming through the cloud, which suggests there's some sort of rays of hope here. So potentially we're in somewhere between this bottom left quadrant towards this central bit here. The upside risk, of course, is that inflation fades really, really quickly and that growth recovers, but they don't seem to be particularly confident of that, but they do mention it on there. So that's the two outlooks from JP Morgan and from Barclays, and when we combine them, we can sort of get a similar view here. When we look at equities, we're sort of looking, or indices, we're looking at a potentially a 10% fall from when they released it, which is H1 of next year to be really, really volatile. Now the key takeaways we've got from JP Morgan really here is that they mentioned that inflation should start to moderate as supply chain issues ease. They say there will be a mild recession in 2023, the same as Barclays, and they seem very excited about bonds. I found it really interesting how they mentioned the continued safe haven currency flows into the US dollar, and they do believe there's going to be low earnings expectations in stocks. Now, that can work two ways. Low earning expectations in the fact that companies aren't going to perform as well, so maybe equities will fall, but maybe the expectations are going to be so low that there is room for some upside, and they do have that optionality in there as well. When we combine both the reports, they're fairly negative going into Q1 particularly, so we're going to be looking at potentially an S&P 500 short, a big swing short there, and maybe an area we can find some real US dollar strength off the back of maybe some weaker sterling or maybe some weaker euro. Okay, so let's find that trading opportunity now off the back of what JP Morgan have said about 2023 and Barclays have said about 2023 into a potentially swing trade idea on the S&P 500. So when I get my drawings back up on the chart here, you can see first of all, this is a daily time frame. You can see just how from January, to the end of the year, how this trend line has been respected really, really nicely. Not a massive fan of trend lines, but this particular one on the S&P 500 is really, really strong. When we zoom in on what's happened, once we run into this trend line here, we have reacted to the downside, and at the same time, you can actually see that we've tested this supply zone we have in here. So this was the last sort of buy to sell candle from the last run down in the S&P 500. So this was always going to be act as a resistance level. Now, as it stands at the moment, we're in really, really critical areas on the chart, because you can see after this is the CPI for November, and we had that real spike in and that liquidity sweep that we've had of this trend line and this high here that I've marked at 4,100. We've now snapped back and closed back underneath there. So really the bears are very much still in play right now, and the targets that we've got for the S&P 500 would be this 2023 Barclays forecast at 3676.5, which happens to be, if we have a look at the info line, we can see that that is around 8 to 9% lower than the market is right now. Barclays do believe that global equities are going to fall around 10%, but the US particularly are showing rays of hope, so maybe 8% is about right. Now, I do believe that next year we're going to maybe go lower than this, but end the year up. So maybe we're going to see a big volatile risk-off event move down below the 2021 lows, and then some market volatility before we actually come and average out around that Barclays forecast, potentially, if they're correct, at 3675. There's also lots of candle imbalance on a 4-hour chart here to target for the S&P. So 3813 is a sensible target. Now, when we look on the 4-hour chart from this daily liquidity sweep and move into the supply zone, there'd be no reason why the bears won't be active in the market, from around the 4,000 level. If we can get a close below 4,000, I do believe we can get a real run of this liquidity at 3910, then at 3813, and then eventually to that Barclays forecast of around 3676. The dollar index is a little more difficult, and this is back off the back of what JP Morgan have said about those renewed flows into safe haven currencies like the US dollar. And this is the DXY chart, the dollar index on a daily time frame. You can see that potentially we are getting a general momentum shift to the downside after trading much higher for quite a long period of time. We're now starting to create these series of lower lows and lower highs, and we're breaking structures along the way. So the key from what JP Morgan have said is, where can we get this support from? So that's what I'm going to try and mark today. And I believe that we're going to get a bit more weakness in the DXY, but maybe it's only going to be to around this 102.5 level. Now, this is really critical level at 102.5, because if we do get a break below that 102.5 down towards 101.2, then we look like we can open up levels that are way below 100. If this level can hold, I believe that JP Morgan are trying to say that we can get that renewed, hope into the US dollar rally trade. And I think that the key target to look out for would be the middle of this imbalance level, maybe this supply zone here. So let me just mark them quickly so they're nice and clear. This was the sort of the last buy before the sell candle that we've had on the rundown. So that can be a supply zone that we target. But alternatively, if we're a little bit more cautious in our approach, we can target maybe this candle imbalance we have here to be a real magnet to drag to pull prices back up. So that's around the 108.9. So that's quite high, quite a lot higher from where we are now at 103.8. But that's judging on what JP Morgan have said in terms of the risk-off currencies performing well early next year.
So there we have it. 2 of the top banks in the world giving their 2023 outlooks. When they speak, we should listen, and I hope this video has given you a simplified insight into what these market movers think, and as a result, giving you a bias as you dive into the charts for the first time in 2023. And this is a very powerful edge. As always, if you have any questions, feel free to drop them in the comments section. Other than that, don't forget to like and subscribe to the channel for more videos just like this, and follow our socials for regular market updates. Until then, trade safe, and we will see you on our next live stream.